Okay. So today we'll start with a new area. So last class we have done something called as dividend analysis, wherein multiple models were discussed. Today we'll start with security analysis. In security analysis, basic thing which we are going to do is we are going to see how to value any security. So valuation of a share, valuation of a debenture, valuation of a convertible instrument, other miscellaneous areas. All of that is what is going to be covered in this area called as security analysis. Now, as a concept of finance, our concept of valuation with respect to any asset, if somebody wants to find out the value of a car, technically the value of any asset is the present value of future cash flows associated with the asset discounted at investors required rate of return. So you can value anything you want to. The rule of valuation is get the future cash flows associated with the asset and discount it at the rate of return you want. For example, if I am the owner of this building and I want to value this building, technically what I should do is I should think how many years I'm going to stay in this building, get the value accordingly. So year 1 how much rent I'm going to receive, year 2 how much rent I'm going to receive, year 3 how much rent I'm going to receive. I'll stay in this building, or I'm going to own this building for a period of 20 years. So from year 1 till year 20 I get the rent cash flows. At the end of year 20 I'm going to sell this building for 4 crores. That's my estimate. Everything is my estimate. Once I get the cash flow, for valuation of any security, what you need is cash flow structure, basically year and cash flow. How much cash flow is going to come in and in which year are we going to get that cash flow? If you are able to get the structure of year and cash flow for any asset class, if I want to value this laptop, I can value the laptop again with the same logic, saying that year and cash flow. Wherever there are productive assets, so a car is not considered to be a productive asset in the sense I'm not going to generate revenues out of it. I'm not going to generate revenues out of a TV or a mobile phone. So there it is more of the benefits which you get which are intangible in nature. So I am having a laptop because of XYZ reason. It's not because of revenues which I get. I use a two-wheeler because of XYZ reason. I use a car because of the comforts which I get in. Those can't be valued. Your comforts can't be valued. What can be valued is the pure cash flows which you can derive from an asset class. So if you have any asset class and you can get a structure called as year cash flow. If you are able to get the structure for any asset class, be it shares, debentures, convertible instruments, intangible assets like land, building, plant and machinery, anything you are able to get this, then there will be something called as PVF, DCF. PVF at, this is the discount rate you use. You may use 10%, I'll use 12%, someone else will use 14%, somebody else will use 16%. Any transaction which happens on sale or purchase of a building or any asset class, what happens is there is one person who thinks that the property is kind of overvalued, another person thinks that the property is kind of undervalued, then only somebody says. So in a market, when I am buying a share, I think share price will go up. Somebody else is selling the share, he thinks share price will come down. So accordingly a transaction happens. So whenever buy or sell is happening of any asset class, obviously the expectation of the two sets of people are different, and that expectation comes because of this parameter. Because my year end cash flow of any asset class is going to remain more or less same. Somebody will discount at 10%, somebody will discount at 14%, somebody will discount at 18%. When you discount at 10%, the property value is 1.5 CR. You increase the discount rate, the property value becomes 1.2 CR. You further increase it, property value becomes 1 CR. Now, if I am this category of a person and somebody is ready to sell a property for 1.3 CR, I'll be happy buying it because my valuation is 1.5 CR, and these set of people will be happy to sell it because according to them the value is 1.2 CR or 1 CR. So any transaction which has to happen, it will only happen if two sets of people are having opposite views on asset class. And the most important thing is, practically in case you decide to value anything, be it land, building, plant and machinery, companies, anything you want to value, think about this. If you are able to get this, you will be in a position to value anything. There are various models of valuation which anyway we will discuss in this area. But if at all I have to value, somewhere somebody says that we'll have to value this business, you ask them, can you give me this information, year and cash flow. Practically it's not that easy to get year and cash flow information, but yes, if you can get it, great. So if I am a owner of a building, every year what rent I am going to earn or what rent I am going to save. Finance doesn't think it has to be only inflow of cash, it can be an avoidance of outflow of cash. So when I am buying a building, it could be for two purposes: revenue enhancement, which is earning rent, or cost reduction, which is reducing rent. So it can be for any set of purposes. The obvious expectation is any asset class has to do increase your cash flow. An increase in cash flow can happen by having extra inflow or by having lower outflow. By having extra inflow or by lower outflow. That is from a broad overview point of view. Now I'll specifically come to bonds and shares in some time. We'll first start in shares with a small area called as rights issue. Then I'll go to share buyback, and then we do something called as valuation models. There are different valuation models. Some of them you've already learned. Walters is one valuation model. Gordon's is another valuation model. Apart from that, I'll introduce few more valuation models called as free cash flow model, earnings growth model. So all of those will get introduced. Now coming to a concept called as rights issue first. So first we'll discuss on rights issue. How many of you are yet to get workbook? One, two, three. I'll get it printed. Again, I've run out of workbook, so I'll get it printed and give it to you. Okay. Now, rights issue is something which you would have come across earlier, either from an accounting point of view or at least from law point of view. What is rights issue? What is rights issue? Shares are issued to the existing shareholders. Whenever a rights issue is made, most probably the rights issue price will be lower than the current market price. Your rights issue price will be lower than the current market price. To give an example, there's a company called as Haxan Agro Limited. So this company's current market price is at around 740 rupees. It announced a rights issue some 3-4 days back at the rate of 555. So the current market price is 740 per share. Your rights issue has happened at 555. So let's take an example. Current market price 1000 rupees some company. Rights issue 800 rupees. This is what a company has announced. So your current market price is 1000 rupees and they are announcing a rights issue at 800 rupees. Whenever a rights issue is made, there will be something called as rights share. That is how many shares or how many rights will be given for the number of shares which are held. So there will be a rights ratio which will be given. So let's take that. Rights ratio is 1:4. That is, if you are holding 4 shares, you are eligible to get 1 right share. If you are holding 4 shares, you are eligible to get 1 right share. Now, technically what they say is, whenever a rights issue is made, the shareholder should either subscribe to the rights issue or he should sell the right of subscribing to the rights issue. If he does nothing, the wealth of the shareholder is theoretically expected to come down. The wealth of the shareholder will come down in case you don't do anything with the rights issue. Now just to give an example, this company will have 1 lakh shares as of now. So 25,000 rights issue shares will come. 1 lakh shares are currently available. 25,000 shares are going to come out of rights issue. If nothing else changes in the company, when I say nothing else changes in the company, concept of finance says that a value of the company can only increase if you get projects which are positive NPV. So as you keep doing positive NPV projects, your wealth can increase. Otherwise, the wealth of the company or the value of the firm is expected to remain constant. So now, post the rights issue is made, theoretically the value is expected. So I'll give the formula, but the theoretical value is 1000 into 1 lakh plus 800 into 25,000 divided by 1,25,000. 1000 into 1 lakh plus 800 into 25,000, just a weighted average. It will be 1000 into 1 lakh plus 800 into 25,000 divided by 125. Can you tell me what number will be this? X rights price. Everything is covered in the theory. You understand the calculation alone. 1000 into 1 lakh plus 800 into 25,000 divided by 125. Is it 960? Now, if you are a person holding shares of this company, let's assume you are holding 100 shares in this company. The company makes a rights issue. Before the rights issue is announced, the wealth of yours is 100 into 1000 rupees. You own a wealth of 100 into 1000 rupees. The moment the rights issue is completed, your wealth will become 100 into 960. Your wealth will become 100 into 960 if you keep quiet. If you keep quiet and don't do anything on the rights issue. Whenever a rights issue is made, indirectly somebody is ready to give you free shares or somebody is ready to give you a discounted value shares, and you are not doing anything on it, your net worth will come down. So as of now, you own a net worth of 100 into 1000. You keep quiet, it will become 100 into 960. Now there are two options. One, you subscribe to the rights issue. If you subscribe to the rights issue, your wealth is 125 into 960. 125 into 960. But to subscribe this, you have paid 25 into 800. To subscribe to this, you have paid 25 into 800. Your earlier wealth is 100 into 1000. That is the amount of wealth you had. If you are not doing anything during a rights issue, your wealth will become 100 into 960. In case you decide to subscribe to the issue, it will become 125 into 960 minus 25 into 800. How much is this? 1 lakh. You come back to 1 lakh wealth. That is by subscribing to the rights issue. If you subscribe to the rights issue, you come back to the wealth of 1 lakh. Other option which you have is practically called as selling a right. That is, instead of subscribing to the rights issue, I can sell the right to someone. I can sell the right. Now, how do I sell the right, or what is the value of the right is? Instead of me subscribing, I'll give it to someone else saying that you can subscribe to it because I don't have money to subscribe to it. And I tell him that according to all the calculation, X rights price will be 960 rupees. You are going to subscribe at 800 rupees. So you pay me 160 rupees per share. You pay me 160 rupees per share and go ahead and subscribe to the rights issue. So the value of a right is 160. How 160 is? Person will subscribe at 800. You are going to subscribe at 800. You pay 800 to the company. You will pay 160 to me. After paying 160 to me, you will get a share worth 960 rupees. You are not bothered about it because you wanted the share. You are okay getting it at 960 rupees. 800 to the company, 160 to me. Now my wealth will become 100 into 960. 160 into 20 or 25 into 160. This is the cash I'll get. 100 into 960 plus 25 into 160. Anyway, I'm going to explain this in detail with a problem. But the basic concept of a rights issue is that whenever there is a rights issue made, you should not keep quiet. If you are either subscribe to the rights issue or sell the right, anything is fine. But non-subscription of the rights issue will lead to something called as wealth reduction. It's your wish whether you want to subscribe to the issue or sell the right, whatever way you want to do it. But as a shareholder, you should never keep quiet. Clear? Any doubts on this? Yeah. Correct. So in case of practical scenario, for example, this Hudson Agro, which they announced the rights issue, on that day market was not great because of extra other reasons, because of results your election results had come in. After that, Karnataka, a lot of issues were going on. So any issue happens in the economy, your share Sensex market gets impacted, be it political or economic. Also crude was going up at the rate of 80, so petrol prices were going up. So anyway, the market was very negative on that day. So whether because of the rights issue, it was not because of the rights issue, because of the market condition itself, the share price came down. So practically anything can happen. Practically on that day, it all depends on the market mood, because markets, the broader markets, if they are negative, most probably all the shares are, majority of the shares will be negative. So that depends on the market mood. It depends on a lot of factors. Suddenly government makes some announcement, you will see market moving up, market coming down, budgets announced. So all of those are practical aspects. See, if everybody is aware of all the concept of finance, no trading will happen in the market. When I say no trading will happen in the market, because you think the value of the share has to be 800. If you are holding a share worth 700, you are not going to sell it. Everybody else wants to buy it, but you are not ready to sell it. So if everybody is aware of exact all the concept of finance, then practically no trading will happen. In markets, lot of irrational trading will happen. Somebody will come and say that the share is going to go up, you'll end up buying it. So all of those happen. So those are the practical aspects. Human emotions also play a part in your shares going up and shares coming down. So those aspects are eliminated. What we are learning is to how to do a fair valuation of a security. Now after doing a fair valuation of security, it's up to you whether you can follow it. Sometimes it's difficult to follow the fair value, because markets will move up like anything, will come down like anything. So all of those are beyond our control. Clear? Now let's start with few problems on rights issue. So this is your topic number 24 on rights issue and buyback. This is there in new syllabus also. So everything is there in new syllabus except those initial 13-14 topics which is related to capital budgeting and leasing. Those topics alone are not covered in new syllabus. So I had started with dividend decision. Dividend decision is not a separate chapter for new syllabus, but if you see your study material, you read in detail, it will be forming part of sub part of lot other chapters. This is anyway a separate area for your security analysis. All of this will be a separate area. So rights issue will be part of chapter 5 of new syllabus. So where this forms part of, you will get it here. So initially it says it's forming part of which chapter for old syllabus, forming part of which chapter for new syllabus. So rights issue and buyback is chapter 6 of old syllabus, chapter 5 of new syllabus. So everything else which we are going to discuss is common to both the set of syllabus except this, which is these areas, basics of capital budgeting, investment decision. All of that is not there, but apart from that, all other areas, totally 60 topics are there. Predominantly everything is there for new syllabus. Okay, let's start with this. ABC Limited has issued 75,000 equity shares of 10 each. The current market price per share is 24. The company has a plan to make a rights issue of one new equity share at a price of ₹16 for every 4 share held, required to theoretical post rights price, theoretical value of the right, effect of the rights issue, effect if the same shareholder does not take any action and ignores the issue. How many of you did not get the notebook? 2 notebooks were to be given. Workbook and notebook. There are 2 things. You are yet to get notebook. Coming to the first part, it says theoretical post rights price. I'll give you the formula and also the logic behind the formula. So write theoretical post rights price equal to theoretical post rights price equal to theoretical post rights price equal to existing shares into existing price, existing shares into existing price, existing shares into existing price plus new shares into issue price plus new shares into issue price, new shares into issue price, whole divided by existing shares plus new shares, whole divided by existing shares plus new shares, whole divided by existing shares plus new shares. In short, we are taking a weighted average of whatever shares are available. Your existing shares into existing price is technically called as the existing value of the company. The value of the company will increase if some more cash is coming into the company or some more equity is getting raised. So existing shares into existing price plus whatever shares you are issuing, that will kind of enhance the value. Denominator also gets enhanced because you are issuing new shares, equal to how many existing shares are there? 75,000 into 24, 75,000 into 24 plus what is the rights share they have said, rights issue ratio 1:2, so 18,750, 18,750, 75,000 into 24 plus 18,750 into 16 rupees divided by 75,000 plus 18,750 divided by 75,000 plus 18,750. $75,000 into 24 plus 18,750 into 16 divided by 75,000 plus 18,750. $22.4. That will be a rights issue price, post rights. X rights issue price. Sir? Yeah. Okay. Any doubts on your X rights price? Any doubts on the X rights price? 22.4. Now, theoretical value of the right is, somebody is saying that I give you a right to buy a share at the rate of what? 16 rupees. So today I subscribed it at 16 rupees and in few days this will become 22.4. Today I get something at 16 rupees. In few days it is expected to become 22.4. Clear? Any doubts on this? Your X rights price, that is post the rights issue is done, the share price is going to be 22.4. So that right which you have is worth 6.4 rupees. Every right you have, one right to buy a share is worth 6.4 rupees because nobody else can buy this at 16. An existing shareholder only get it at 16. So if you get it at 16, after few days the 16 will become 22.4. The 16 will become 22.4. But are we generating more money out of this? No. your 24 will also become 22.4. Your 24 will also become 22.4. Loss on that is compensated by the gain here. So 16 will become 22.4 and 24 will become 22.4. The other issue is if you have 4 shares, then only you will get 1 right. So you will lose 1.64 times and gain 6.4 one time. So net you don't make any money, you don't lose any money if you subscribe to the rights issue. If you are owning 4 shares, you will lose 4 into 1.6 and gain 1 into 6.4. That theoretical value of the right is technically, the formula is X rights price minus rights issue price. But the logic behind that is, today you get something at 16 and this will become 22.4 in few days. So what they are saying is, you are getting a benefit, why don't you pay something more? So we say, yeah, we are ready to pay, or there is a worth associated with this instrument. That right which you have a right to subscribe the share at the rate of 16. That right, the value of that right is 6.4. You own that right and there is a value attached with that right. Now it's up to you whether you want to use that right or sell the right. If you are selling, you will sell it at 6.4. Clear? Any doubts on this? Next, theoretical value of the right. Theoretical value of the right. X rights price minus rights issue price. Value of the right. X rights price minus rights issue price. Any doubts on 6.4? So it's up to you whether you want to do it or sell it, but you have to do one of them. Keeping quiet, you will see that in some time. Any doubts on 6.4? No need to remember the formula, be clear on the logic. Third part says, show the effect of the rights issue on the wealth of the shareholder who has 1,000 shares, assuming he sells the entire rights. Show the effect if he does not take any action. 3 things can happen. I'll end up doing all the 3. 1, you subscribe to the rights issue. Second, you sell the right. Third, you ignore the rights issue. Subscription and sell will lead to same net worth. Ignorance will lead to wealth reduction. So he is holding 1,000 shares. So let's do all the 3 scenarios. In one case, he'll subscribe to the rights issue. Second case, he will sell the rights. And in the third case, he is going to ignore the rights issue. Clear? So next, effect of the rights issue on wealth. Effect of the rights issue. Effect of the rights issue. Issue on wealth. Particulars in 3 columns. You got 2 notebooks? You just take your notebooks. Effect of the rights issue on wealth. Particulars in 3 columns. So first one is subscribes to the issue. This is not there in the question, but we are doing all the parts. Subscribes to the issue, sells right, ignores right. You can do one of the 3. Either you subscribe to the issue, or you sell the right, or you ignore the right. Subscribe, sell, or ignore. Subscribes to the issue, sells right, and ignores right. Subscribes, sells, and ignores. Now listen for some time. I don't want you to write anything. I'll tell you when to write. This person is holding 1,000 shares at this point of time. So existing wealth 1,000 into 24. This is what was there with me before the rights issue was announced by the company. 24 rupees per share into 1,000 rupees. I was happy with the 24,000 wealth. Post the rights issue, number of shares post rights price, value of shares. I'll explain this, just give me a minute. Now if I subscribe to the issue, I will end up holding 1250 shares. I can buy another 250 shares from the company. If I sell the right, I'll continue to hold 1000 shares. If I sell the right, I'll continue to hold 1000 shares. If I ignore also, I'll continue to hold 1000. This will be 22.4 irrespective of the scenario, because this is what we have calculated. Your post rights price has to be 22.4. Value of the shares is this much. Now in this scenario, what is going to happen is I will have to borrow money from someone, because I don't have money. My net worth was 24,000. That's the only thing I had. So here I have to buy 250 shares. So these 250 shares will have to be purchased at the rate of, what is the rate at which we are buying? The rights issue is made at 16. In this case, what I will do is, those 250 rights I have, I'm selling it at 6.4. I'm selling them at 6.4. In one case, I am subscribing to the issue at the rate of 16 rupees. In the second case, I am selling them at the rate of 6.4. Third case, I don't do anything. So I don't have a cash, I don't have a borrowing. This minus this will be 24,000. This plus this will be 24,000. This plus this will be 22,400. There's a wealth reduction which happens. Why a wealth reduction happens in the third scenario is, you lose 1.6 per share and don't gain anything. You lose 1.6 per share and don't gain anything. Here you lose 1.6 per share for 4 shares and gain 6.4 per share for the rights issue share. In this case, you lose 1.6 and earn a cash of 6.4. Earn a cash of 6.4. So this scenario and this scenario, your wealth is going to remain same. Whether you subscribe to the rights issue or sell the right, the only problem is if you ignore a rights issue. So practically, whenever a rights issue is made, first it has to be lower than the current market price. If it's lower than the current market price, you should subscribe to the issue. Whether you have money or you don't have money, by borrowing, whatever means, a rights issue should be subscribed, and after that you can end up selling it if you want. You do see, either you sell the right, sometimes selling the right is not possible, you are not getting a person, you subscribe to the issue, after 3-4 days when the shares are allotted, you sell it, that's all. So you end up making more money. So as a concept, rights issue needs to be either subscribed or sold if it's at a discount. If it's at a discount. So show this now. Technically, yes. Yeah, so as a concept, what you say is perfectly right. So what she is indicating is, when I did this denominator 18,750, some people may not subscribe to the rights issue. So in your numerator also, it should not be 18,750 into 16. Denominator also plus 18,750 should not be there. Perfectly fine, but we don't know practically how much is going to be the percentage of rights issue subscribed. So this is theoretical. As of now, I go ahead with it. But as a concept, what you say is right, because sometimes denominator will get added only by 16-17,000 because everybody is not subscribing to the rights issue, and your numerator will also become plus 17,000 into 16 or plus 16,000 into 16. So should I calculate the updated number? Not, why I don't do it is, this ignores, right, not only by this person, there can be multiple other persons also doing it. Yeah, so I agree perfectly on it, but as most of the solution institute has not done this adjustment. The logic for that is, there are some more people also ignoring the right, you don't know all of that. So because of that reason, you altogether don't consider this analysis saying that whether 18,750 subscribe or not. When I put this formula, theoretically my assumption is that everybody will subscribe to the rights issue. That's why 75,000 plus 18,750 happens. If some people are not subscribing, obviously the denominator has to come down with the corresponding fall in your numerator. So both of them will have an impact. Only one request, don't copy anything from the board. If you have understood it, you do it on your own. There's nothing to refer to the board. Wherever you are having a doubt, you can refer to the board. Otherwise, please keep doing on your own. In case you have doubt, you can refer, but otherwise try doing it on your own, because not a complex calculation or something. You can then finally write a conclusion saying that net worth will fall if the investor does not subscribe, or if the investor ignores the rights issue. If you ignore the rights issue, your wealth will come down. You sell it or subscribe it, anything is fine. The wealth of the investor will fall in case he ignores the rights issue. Clear? Can you proceed? Any doubts? I'll go to the next question on the rights issue part. ABC Limited has paid up ordinary share capital of 1 crore of 2 crores represented by 4 lakh shares of 50 each. Earnings after tax in the most recent year were 75 lakhs, of which 25 lakh was distributed as dividend. Current P multiple. Company is planning a major investment which will cost 202.5 lakhs. Expected to produce additional after tax earnings over the foreseeable future at the rate of 15%. It was proposed by CFO to raise necessary finance by a rights issue at a price of 25% below the current market price. You have been appointed as a management consultant and are required to calculate current market price, price at which the rights issue will be made, number of new shares that will be issued, the price at which the shares of the entity should theoretically be quoted on completion of rights issue. It has been said that provided the required amount of money is raised and the market is aware of the earning power of the new investment, the financial position of existing shareholders should be the same whether or not they decide to subscribe for the rights. You are required to illustrate that there will be no change in the existing shareholders' wealth. Go through the question. So they've clubbed the rights issue with some data on utilization of the rights issue. They've asked what is the current market price of the share, price at which issue will be made, number of shares, and post rights price. How will I get what is the current market price of the shares? Some information is there. Which one? 1 by P multiple. So, okay, so after that, somewhere the cost of capital is given, not given in the question. No, so it's with P multiple. With P multiple, how will you get it? No, so you can. So the point is, I had explained there also. Your P multiple concept says that when there is 100% dividend payout, then only P multiple works. If there is 100% dividend payout, the concept of P multiple works. If there is no 100% dividend payout, it normally doesn't work. EPS into P multiple. You will get to the EPS. With the EPS, you're going to multiply the P multiple. If you see here, it says earnings for the most recent year were 75 lakhs. I know the number of shares which are there. Earnings by number of shares will give me earnings per share into P multiple will give me the market price of a share. Working note 1, calculation of the current market price. Calculation of the current market price. Calculation of current market price. Particulars amount. Particulars amount. Start with total earnings. Total earnings. How much the total earnings? 75 lakhs. Total earnings 75 lakhs. Number of shares. Number of shares. How many shares are there as of now? 4 lakhs. Wherever P multiple is there and EPS can be computed, EPS into P multiple is your MPS. So divide this and get earnings per share. Earnings per share. Earnings per share. After earnings per share, what we capture? P multiple. P multiple. What's the P multiple? 8. And you will multiply these two and call it as market price. So the current market price of the share is 150 rupees. Current market price of the share is 150 rupees. Any doubts on this? Part 2, part 3, let's do it in the same working note. Price at which the rights issue will be made. They have given some information on rights issue. What should be the rights price? They have given 25% below the current market price. Next, rights issue price after market price. Rights issue price. It has to be 25% lower than 150. 25% lower than 150. Current market price. Any doubts on the rights issue price? Number of shares to be issued. Whatever money you want to raise, divide by 112.5. Money to be raised. whatever money to be raised divided by 112.5. Divided by 112.5. Any doubts in this? Clear? Can we proceed? Okay, now please listen. The part 4 is asking for the X rights price. If I have to do X rights price, you are done till this, then I proceed. Done. Now listen for some time. If I have to do X rights price, it is 4 lakh shares into 150 plus 1,80,000 shares into 112.5 divided by 4 lakh plus 1,80,000. This is what I have told you. Now there are going to be changes to this. There are going to be changes to this. Now I'll explain. Whenever a company does any project, whatever I gave the formula is broadly fine. Yep.
So they have earned 75 lakhs, out of which they have been given of 25 lakhs, they have 50 lakhs.
But they still want to raise it from the public. They are saying 202.5 lakhs. It was proposed to raise the necessary finance by a rights issue.
Necessary finance. So they want to 2.25 lakhs, they have 50 lakhs.
Okay, now subject to two sets of interpretation. The first interpretation is 50 lakhs could have been retained by the company for doing their regular projects. So there will be something called as a regular maintenance capex which a company has to do. So for that purpose, the 50 lakhs could have been retained by the company, and this is a new project which the company is getting. So for that they need 202.5 lakhs, and that's why I'm dividing by 112.5. So her question is 202.5 lakhs is what we need. Anyway, we have a retained earnings of 75 minus 25. So why don't I use that 50 lakhs and raise money only for the balance 152? Interpretation can be done that way. I'm just taking whatever institute interpretation is, and it's not institute interpretation. Any normal question, I'll take this interpretation only, because that 50 lakhs which would have been retained will be needed for the regular capex of the company. There are two types of capex or capital expenditure a company does. One is called as maintenance capital expenditure, and the second is called as growth capital expenditure. What is maintenance capex is your plant and machinery will continue to need some modernization. So even if you are not increasing your revenues, still you will have to spend more money on plant and machinery to modernize them, to renovate them, to buy some balancing equipment. So that regular capex may consume that 50 lakhs. That's the assumption. So their regular capex may consume 50 lakhs. Your balance 202.5 lakhs, whatever they are going to raise, entirely it's going to come from rights issue. Can your interpretation be done? Yes, you write a note on it, but most of the times, it's not what institute has done. Most of the times I'll end up doing this interpretation only. Now coming to this 202.5 lakhs, whenever a company announces that they are going to do something, that something will either be a positive NPV project or a negative NPV project. If at all I'm doing a project, so if it's a positive NPV project, my share price will go up. All this theoretical calculation. If it's a negative NPV project, my share price will come down. So in this case, my price is going to be 4 lakh into 150 plus 1.8 lakh into 112.5, whatever it was, plus NPV. Can be plus or minus depending on whether it is a positive NPV or negative NPV. Now in a practical world, whenever a project is announced, if a lot of people will do the financial analysis of that, and immediately the share price will either go up or come down. So today I say that I'm going to set up, Maruti says that we are going to set up a plant to manufacture 5 lakh cars. The moment they announce it, people will feel it's a good news or a bad news, and immediately either the share price will go up or come down. So the market will factor it immediately. They will not wait for them to start earning profits and then factor it. So some part of the news gets factored in the moment it is announced. Balance part gets factored in as and when the company starts showing. So here I'm going to do a project worth 202.5 lakhs. This 202.5 lakhs will give me 15% earnings. 202.5 lakhs is going to give me 15% earnings. How much is this value? How much? 30,375. Okay, this is what the project is going to earn. Now please listen. as a concept of finance, we just now calculated the market price. No, our calculation was 75 lakh divided by 4 lakh. We got to the EPS and multiplied with the P multiple. If I want to know the market value of a company, I'm not interested in knowing this and all. If I just want to know market value, the market value is 75 lakhs into 8. The every rupee of earning is valued by the market. So if you are earning 1 rupee, market will pay you 8 rupees for that. So your market value is 75 lakhs into 8. Your market value today is 75 lakhs into 8, which is 6 crore. 75 lakhs into 8, which is 6 crore. Now what is going to happen is this 75 lakhs into 8 will further go up by 30.375 into 8. It will grow by 30.375 into 8. What is this number? How much? 240. Now what does this mean is you are doing a positive NPV project of 40.5 lakhs. You are investing 202.5 lakhs but bringing to the company worth of 243 lakhs. What we are doing is we are doing a project worth 202 lakhs but market feels the project worth is 243 lakhs. The market's expectation or the feel is that this project is not worth 202 lakhs. The project is worth 243 lakhs. Now to do a 243 worth project, if you spend 243, 0 NPV. If you spend less, positive NPV. If you spend more, negative NPV. Last problem when we did rights issue, I did not know the end application. I wasn't aware what is going to happen. Now please listen. My X rights price in this case is 75 lakhs into 8. What is 75 lakhs into 8 is the existing earnings. I'm not going even by the shares. I'm not bothered about the number of shares information. 4 lakhs into this plus 1 lakh, all of that is ignored. 75 into 8 plus 202.5 into 15% into 8. This is what the market is going to value the company in few days. In few days, the value of the company will become 75 into 8 plus 202.5 into 0.15 into 8 divided by 4 plus 1.8. 4 lakhs plus 1.8. 4 lakh. Listen for some time. I'll tell you some adjustments to be done. If you are clear on this concept, then valuation will become clearer later on when I do mergers and acquisition. 75 into 8, which is the current worth of the company. You can understand it as 4 lakh shares into 150 rupees or 75 lakhs of earnings into 8p multiple into p multiple. Normally, practically, anybody who wants to value the company, he will not ask you EPS. He will not ask you the number of shares. He will just see the total number of total earnings and multiply with the P multiple. That's how anybody does the valuation. So 75 into 8 plus 202.5 into 0.15 into 8 divided by 4 plus 18. This is after the rights issue is done. Now, before rights announcement, before any announcement is done, the value was 75 into 8 divided by 4 lakh shares. 75 into 8 divided by 4 lakh shares. Okay, 75 into 8 divided by 4 lakh shares is what the worth of the company before the rights issue is announced. After you announce rights issue, or in fact not rights issue, project, the moment I do a positive NPV project, my worth has to go up. So the worth will become 75 into 8 plus 243 minus 202.5. It will not go up by 243 because you are yet to raise money. The moment you raise the money, it will go up by 243. So the moment the rights issue is announced, or the moment the company says we are going to do a positive NPV project, the moment the company says there is going to be a positive NPV project, the share price from 150 will go up. The share price from 150 will go up, and then those theoretical X rights analysis, all of that come into picture. But any positive NPV project you do, that is going to lead to wealth increase for the existing shareholders. that is going to lead to wealth increase for the existing shareholders. So I said existing shares into existing price plus new shares into issue price. That formula still holds good, but the existing price is not 150. The existing price is not 150. The existing price is this. You'll have to calculate this and tell me whatever it is, that will be the existing price. So we are going to note all of this, but the concept of finance is that any positive NPV project announced by the company, the market has to react on it. Market will react on it if they are getting the earnings visibility. Somewhere the question says, it has been said that the required amount of money is, and market is aware of the earning power of the new investment. Market knows that it is going to happen. So when the market knows that it's going to happen, our share price from 150, which you see today, will start inching upwards the moment it is announced, and moment the rights issue is completed, it will fall down. Why it falls down? Because of your issue price being lower than the current market price. That is your X rights analysis. Any doubts till now? Now next working note, calculation of X rights price. Calculation of X rights price. Point number 1, the current market price of the share, the current market price of the share is rupees 150. Market price of the share is rupees 150. Full stop. This will undergo a change. This will undergo a change due to the new project announcement. Now please listen, just making a rights issue announcement will not have any impact on the share price except for the market side movements. Otherwise there is not going to be any impact on the share price just because you announce a rights issue. Unless I get to know what are you going to do with that money. If I get to know what is going to happen with that money, obviously the share price will get impacted. Whether it's a positive NPV application or a negative NPV application. Next point. The company plans to do a project worth 202.5 lakhs. Plans to do a project worth 202.5 lakhs. Full stop. We need to compute NPV of this project. We need to compute NPV of this project to find the impact on share price. NPV of this project to find the impact on share price. NPV of this project to find the impact on share price. Next, NPV of the project equal to present value of inflow minus present value of outflow, IPCC. Whatever you have learned there, present value of inflow minus present value of outflow. What is the outflow for the project? 202.5. The present value of inflow is this, 202.5 into 15% into 8. That is what the market is going to value it in some time. 202.5 into 15%. Why into 15%? Is they are going to earn 15% into 8 P multiple. That's the present value of inflow. 202.5 into 15% into 8. Minus the present value of outflow. Two not 2.5 into 15% into 8. It's going to be 243 minus 202.5. How much? 40.5. Any doubts on this? Can I proceed? Next, NPV per share equal to NPV per share. NPV per share is equal to NPV per share is equal to whatever NPV divided by 75 lakhs. Two decimal answer. NPV divided by 75 lakhs. NPV divided by 75 lakhs. Sorry, not 7. How many shares are there? 4 lakhs divided by 4 lakhs. Sorry, divided by 4 lakhs. NPV divided by 4 lakhs. NPV was how much? 40.5 divided by 4. So 10.132 decimal answer. Now, sometimes they'll say, this is a concept which we'll use in multiple questions. They'll say the company plans to do, they'll say currently this is what is happening, the company plans to do a project, likely effect of this on the share price of the company. Whenever I do any project, if there is a positive NPV, whatever is the positive NPV per share will be the increase in the share price. Negative NPV per share will be the decrease in the share price. So my share price will now become 160.13. It will become 160.13. Today it is 150. I'm yet to come to the rights issue. Okay, we are yet to decide. I'm just discussing on the project. You are doing a project. I don't know how you raise the money. I'm not bothered about it as of now. That raising the money may impact the price later on. The moment you announce it, share price from 150 will go up by 10.13. It will go up by 10.13 because it's a positive NPV project. If it was a negative NPV project, it will come down. So the revised share price is 150 plus 10.13. Revised share price is 150 plus 10.13. And this is that formula application, whatever, just to prove that it will become 160.13. I'm yet to come to the rights issue because you need money. It's your wish how you want to raise it. But if you have announced a positive NPV project, 150 will become 160.13. This is announcement of the project, not the rights issue. You want to raise it to the rights issue, then I'll come to the X rights price. Any doubts till now? Any doubts till now? Now X rights price equal to X rights price equal to existing shares into existing price, existing shares into existing price, plus new shares into issue price, plus new shares into issue price, whole divided by existing shares plus new shares, whole divided by existing shares plus new shares. The only important adjustment is existing price is not 150, it is 160.13. Your existing price is not 150, it is 160.13. The reason for 160.13 is because of the NPV of the project, positive NPV of the project. So that was on a base of 150 rupees. When I came to the announcement on that day, it was 150 rupees. So my rights issue was at 112.5. Now I cannot keep changing the price after making an announcement. So my announcement was done at 112.5. People felt the announcement is very positive. They made the price move to 160.13. So that is market reaction.
Why did it take 75 to 8 and not 50?
Which 50?
Multiply is paid.
That doesn't matter, no. Your earnings, it is earnings multiple approach. So whatever earnings you have, you multiply that, not what you retain. If my valuation is going to happen only based on retention, then practically no company will pay dividend, because whatever is paid out, if it gets discounted by the market, I'll pay zero dividend. I'll continue to have 75 lakhs with me and make it into 8 into 8. So that is why it is what you earn rather than what you retain. Clear? Any doubts on this? Now this is nothing but this calculation. 75 into 8 plus 202.5 into 0.15 into 0.8. See, the value of the company does not depend on how many shares you are getting, how many shares you are issuing, what price you are issuing. All of that does not matter. According to the market, the only thing which matters is earnings. Are you generating money out of that money which you are raising? So what we are going to generate is kind of getting valued here. You could have issued even 5 lakh shares if you want to. You make the denominator as 5 lakh, additional 5 lakh. The numerator will continue to be 843. The numerator will continue to be 843. Suddenly the company says, no, we are going to make 300 lakh of an issue. 300 lakhs is going to be raised. And I'm going to issue more shares. Perfectly fine. It's a negative NPV project. If you're going to raise 300 lakh, it's a negative NPV project. What will get added here is only 243 lakhs. How 243 has come is, some part of 243 is got added here in terms of positive NPV, and balance has come here in the form of money to be raised. According to the market, the only thing which matters is earnings. You can keep telling that we are going to do all of this X, Y, Z. If they believe, price will move up. If they don't believe, when I say markets is catered by so many people. So it's not some single person who can influence the market. So if people believe your earnings, price will go up. If people are not believing your earnings, price may not react. If you show the earnings, market will react. So that is how it is. So I am not bothered about how many shares I am raising. I'm not even bothered about how much money to be raised. Even the money to be raised can be 500 lakhs in this case. The numerator will be only 843. Even if you raise 500 lakhs, the numerator is going to be only 843. How it will be 843 is, here it would have been a negative NPV project and the price would have crashed. The price would have crashed because of a negative NPV project. So be very clear, value of the firm is not number of shares into market price of a share. It is total earnings into P multiple. Lot of people keep arguing saying that I don't have information on number of shares. How do I find the value of the firm? I don't need number of shares. I don't need market price. I don't need all of that. Two information: total earnings of the company and the P multiple. These are the only two parameters which tells you the value of the firm. Based on this, you can keep changing this. So when we did this calculation, if number of shares in place of 4 lakhs, if you put 1 lakh, you would have said share price, EPS is 75 into 8, market price would have become 600. So either you say 600 into 1 lakh share or 150 into 4 lakh share, everything is equal to 75 lakh into 8. Everything is equal to 75 lakh into 8. So the critical parameter is the total earnings of the company. So if you have to value a company, it is total earnings into P multiple. I am not bothered about anything else. So if you are doing a project, can it enhance the earnings? Yes, value will go up. No, value will come down. That's how it works. Last problem we didn't have any information on the earnings capability of the company. No information on the post issue, what is going to happen to that money. So we don't know whether it was a positive NPV, negative NPV. So there it is ignored. Any doubts till now? Any doubts till now? 145.35. See, only some of the concept which I'm discussed is getting used here. Major chunk of it will be used in mergers and acquisition and valuation when I do in detail. Any doubts? Any doubts on this? So 145.35 is going to be the post post rights price. Before the rights, before the budget is, before the project is announced, price is 150. After the project is announced, price is 160, and the moment the rights issue is completed, price will be 145. Price will be 145. The jump is because of a positive NPV. This jump 150 to 160 is the real gain of a shareholder. Is the real gain of a shareholder. 160 to 140 is neither a gain nor a loss. It's not a gain, not a loss, because you lose on something, you gain on something else. So it's not something like a loss for a shareholder. Clear? Any doubts on this? Done. Now we have done all the 4 parts. Some extra information. It has been said that provided the required amount, you are required to show the financial position of existing shareholders would be same whether or not they decide to subscribe for the rights they are offered. You are required to illustrate that there will be no change in the existing shareholders' wealth. Okay, they are asking us to analyze the wealth of the shareholder, whether or not they subscribe to the rights issue. So when they say whether or not they subscribe to the rights issue, if you are not subscribing, you have to sell the right. You have to do one of them. If you ignore the rights issue, wealth will come down. Ignorance will lead to wealth reduction. There are no doubts on that. Either you subscribe to it or sell it. I'll do the calculation. You listen for some time. Again, we'll do all the 3. Now taking an example of again some 1000 shares, I'll take an example. So existing wealth is 1000 into 160.13. It's not 150. You cannot compare with 150 because the moment the project is announced, my wealth has gone up. So my existing wealth is this 1000 into 160.13. Before, after that it will become 125. How many shares we are issuing? 1,80,000. Sorry. So 1,80,000 divided by how many shares are there? 4 lakhs. So for every share I'm going to get 0.45 share. For every share I'm going to get 0.45. So my total shares will become 1450. After the rights issue is made, total share will become 1450. Continue to at 1000. Continue at 1000. Post rights prices 145.35. This will be my value of shares, and my cash or borrowing is 450 shares into 112.5 is my borrowing. 450 into 112.5 is my borrowing. In this case 450 will be sold. I'll sell this at 145.35 minus 112.50. X rights price minus rights price. X rights price minus the rights price. So I'll sell this. Here I do nothing. This is what my wealth is going to be. Some rounding off issues can be there if at all it is there. Okay, those are also not there. 160, 130, 160, 130. 160, 130 remains at 160, 130. In this case, it falls down. The critical aspect is either you subscribe to an issue or sell the issue. Doing nothing, the wealth will come down. If you do nothing, the wealth will come down. Another critical parameter is my wealth is not 1,50,000 my starting. My wealth is 160, 130. My wealth moves like this. It starts at 150. They announce the project, it goes to 160, 130. Rights issues completed, I subscribe or I sell, I remain at 160, 130. I do nothing, I fall down to 145. I do nothing, I'll fall down to 145, 348. Any doubts on this? Any doubts on this? We are issuing 1,80,000 shares for 4 lakh. So the rights issue ratio is 0.45 is to 1. 0.45 is to 1. So next, effect on a shareholder's wealth. Effect on shareholder's wealth. Effect on shareholders' wealth. effect on shareholders wealth. Now right, let us assume the investor holds, let us assume the investor holds 1000 shares. Investor holds 1000 shares. Holds 1000 shares, full stop. The company plans to issue, the company plans to issue 1,80,000 shares, 1,80,000 shares for existing 4 lakh shares. 1,80,000 shares for existing 4 lakh shares. Full stop. The rights ratio is 0.45:1. 0.45:1. Any doubts? Now you can show this analysis. You can, the same format, instead of copying it, you end up doing it and then check. You can have rounding of differences if at all it is there. In Excel there will be no rounding of issues. So whatever number you get, you can note that. Basic thing is your wealth will not change if you subscribe or sell the right. If you ignore it, it will come down. Done with this? Any doubts? Any doubts on this? Can we proceed to the next question? Anybody still working out? Any doubts? Okay, completed. Done? Okay, I'll move to question number 3. T Limited is considering undertaking a major expansion involving outlay of 150 crores. Board of directors of company are expecting to generate an additional profit of 15.30 crores after a period of 1 year. Further, it is expected that this additional profit shall grow at the rate of 4% for indefinite period in future. Presently, T Limited is completely equity financed and has 50 crore shares of 10 each. The current market price is 22.6 cum dividend. Company has declared a dividend of 1.4 per share in last year. For the last few years, dividend is increasing at a compounded rate of 6%. The growth rate shall not be affected by expansion. Board of directors are considering following ways. Rights issue on ratio of 1:5 at a price of 15 per share. A public issue of shares. In both cases, dividend shall become payable after 1 year. You as a financial consultant required to determine whether it is worthwhile to undertake the project or not. Calculate ex-dividend market price if complete expansion is financed from rights issue. Calculate the number of new equity shares to be issued and at what price, assuming that new shareholders do not suffer any loss. Calculate the total benefit from expansion to existing shareholders under each of the two financing options. Go through the question. Okay. Now they've given information about an expansion which will involve 150 crores. The first part of the question is whether to do project or not. So they have now focuses on the project. If it's a positive NPV1, I'll go ahead with the project. Negative NPV1, we will reject the project. So you are required to decide whether it's worthwhile to do the project or not. If it's a positive NPV project, share price of the existing people will go up. If it's a negative NPV project, share price will come down. Then some analysis on the X-rights price and some analysis on the public issue part. Now, I'm going to do an expansion which needs 150 crores. The benefit of the expansion is I'm going to generate 15.30 crores after 1 year, and the same will grow at the rate of 4%. I'm going to generate 15.30 crores at the end of first year, and it will grow at the rate of 4% every year. P naught is equal to D1 K minus G. This is the formula for your Gordon's model, technically called as present value of growing perpetuity. So the value of the project is, today's value of project is year 1 cash flow divided by cost of equity minus 4%. Cost of equity minus 4%. So I'm going to generate 15.3 crores profit after 1 year. Perpetuity is always valued a year in advance. So we are going to generate 15.3 crores in first year. The today's value of that project is, present value of inflow is 15.3 divided by cost of equity minus growth rate. Divided by cost of equity minus growth rate. Any doubts till now? Present value of the project is equal to R. When I do NPV, present value of inflow minus present value of outflow. Outflow is 150 CR. Inflow is 15.3 divided by KE minus 4%. 15.3 divided by KE minus 4%, because the project is going to generate 15.3 crores in the first year. It's going to generate 15.3 crores in the first year, and thereafter it is going to grow at the rate of 4%. If it generates in first year, the value of that is computed in year 0. Any doubts till now? Now the next part is, I will have to get the cost of equity. Anywhere the cost of equity is there in the question. Not like the previous problem where we had a P multiple. So if we had a P multiple, I would have done 15.3 into P multiple. There is no concept of P multiple in this question. Cost of equity.
I cannot see it in my data. We have the current market price which is given, the growth rate is given, and the dividend is given. Using that Gordon's model, we can.
Yeah, so using the Gordon's model, you are going to get the cost of equity. Both the aspects are going to be through only Gordon's model, and its Gordon's model is not which I am introducing at final level. It's learnt at IPCC level. At IPCC level, you would have learned cost of equity equal to constant growth in dividend, D1 by P naught plus growth rate. This is what you would have learnt at IPCC level. D1 by P naught plus growth rate. That will give me KE. The same formula will also give me the present value of inflow. With that, I'll get the NPV of the project. Working note 1, calculation of NPV of the project. Working note 1, calculation of NPV of the project. Calculation of NPV of the project. KE, cost of equity. KE equal to D1 by P naught plus growth rate. D1 by P naught plus growth rate. Now this growth rate is not for the project I am analyzing. I am now analyzing the equity share. Equity share gets its return in the form of dividends. D1 by P naught plus growth rate. What is the growth they are saying on dividends? Dividends. 6%. That 4% is for the project which you are doing. I am not analyzing the project as of now. I am getting the cost of equity of the company. So listen for some time. It's D1 by P naught plus growth rate. There's one important adjustment to be done here. What is the growth they are saying? 6%. My D1 is going to be, last year it was 1.4. So 1.4 into 1 plus 6%. 1.4 into 1 plus 6%. D1 by P naught plus growth rate. Next year dividend is 1.4 into 1 plus 6%. Growth is 6%. What is the current market price? 22 point. Read it again. What is the current market price? What is the current market price? What is the current market price? Is it 22.6? It's not 22.6. 22.6 is the price of share plus dividend. Is the price of share plus dividend. We learned this in the earlier dividends analysis. So theoretically, in few days, the share price will fall by the amount of dividend. So it will fall by 1.4. So the share price is not 22.6. The share price is 22.6 minus 1.4. Just a minute. When we did this was a theory I had explained in Gordon's model. So what we get is FMP under Walters and Gordon's model is X dividend price. So for my formula purpose, that P naught which you are using has to be X dividend price, not the cum dividend price. So if it's a cum dividend price, the formula is not going to work. It has to be X dividend price, and X dividend price is the current price minus the amount of dividend. So my denominator is going to be 22.6 minus 1.4, because 1.4 has been declared and it's going to be paid in some days. I don't know when they are going to pay, but it will be paid in some days. 22.6 minus 1.4. This will only give you KE. This is an important adjustment here. The denominator has to be X dividend price. It can't be the cum dividend price. So 22.6 minus 1. In short, the current market price of the share is not 22.6, because when I calculate my gain, loss and all of that, my price is not 22.6. My price is only 21.2, because the share price in just few days will become 21.2, because as a shareholder I'll get 1 rupee 40 paise dividend. It's not I'm losing anything. I'm not losing. I'm going to get the dividends from them. Do this and let me know the key. Both the parts you calculate in percentage. It is 7% plus 6%, no? 13%. K is 13%. 7% plus this you will have to multiply with 100 after dividing, or you will get 0.07 plus 0.06. 0.07 plus 0.06, 0.13 are 13%. The cost of equity is 13%. 0.07 plus 0.06. Any doubts on cost of equity? So the current cost of equity is 13%. That doesn't matter to the project which we are analyzing. So before the project analysis, I am calculating cost of equity. KE is always with respect to the company. It's not with respect to the project. And project may grow at the rate of 4%, but the company is expected to increase its dividends at the rate of 6%. So I'm not going to link both and do my analysis. Any doubts on this? Next, NPV of the project equal to present value of inflow minus present value of outflow. Present value of inflow minus present value of outflow. Inflow minus present value of outflow, again equal to, my inflow is, I'm going to interchange the formula and it becomes cash flow of year 1 divided by cost of equity minus growth rate. Cash flow of year 1, your P naught is equal to D1 by KE minus D. D1 is nothing but cash flow. So your present value of growing perpetuity is perpetuity amount divided by time value of money or investor expectation minus growth rate. So what you are going to do is cash flow of year 1 divided by cost of equity minus growth rate minus 150 crores. Tell me the NPV of the project. Let it be in crores itself. Any doubts in this? Any doubts in this? Clear? So you can write there, the company should go ahead with the project as it generates a positive NPV of 20 crores. The company should go ahead with the project, as it generates positive NPV of 20 crores. Should go ahead with the project as it generates positive NPV of 20 crores. As it generates positive NPV of 20 crores. Clear? Any doubts on this? So this is going to generate a positive NPV, so we are going ahead with the project. Clear? Determine whether it's worthwhile to do the project or not. Calculate ex-dividend market price of share if complete expansion is financed from the rights issue. Now, ex-rights prices existing shares into existing price plus new shares into issue price divided by existing shares plus new shares. But before doing this, I'll have to first adjust the existing price itself, because positive NPV will move up the price. When there is a positive NPV project we are doing, the price will go up. Next, calculation of X rights price. Calculation of X rights price. calculation of X rights price. Point number 1, current X dividend price. Current X dividend price. Current X dividend price. Without dividend, what is the price now? 21.2. Sorry. Okay, 21. Current X dividend price is 21.2. Now, the moment the project is announced, the price will move up because it's a positive NPV. It's because of the project, not because of the rights issue. Then revised existing price. Revised existing price equal to revised existing price equal to revised existing price equal to 21.2 plus NPV per share. 21.2 plus NPV per share. Plus NPV per share. $21.2 plus NPV per share. What is the NPV per share? 0.4, 20 by 50. So price will go up to 21.6. This is not because of the rights issue, this is because of the project announcement. So the moment the project is announced, price will start going up, and it goes up from 21.2 to 21.6. Any doubts in this? Then X rights price, existing shares into existing price plus new shares into issue price divided by existing shares plus new shares. X rights price. X rights price. Existing shares into existing price plus new shares into issue price The important thing is your existing price is 21.6, it's not 21.2. Be careful about that. The moment the project is announced, yeah. 50 crores, no? 50 or 5? 50 crore shares of 10 each. So 50 crore shares are there. So 50 into 21.6 plus 10 into 15. 1:5. 10 into 15 divided by 50 plus 10. So the X rights price is 20.5. Any doubts on this? Clear? Then we'll proceed to the next part. Now this part says calculate the number of new equity shares to be issued. That is, I need 150 crore rupees new equity shares, and at what price, assuming that new shareholders do not suffer any loss after subscribing new shares. They are saying you tell us how many shares are to be allotted and at what price, assuming that a person who comes into the company does not suffer any loss. So if I'm subscribing to this issue at 100 rupees, after the issue is closed, the price should be 100. Then only I don't suffer any loss. So my objective is issue price and post issue price should remain same. Issue price and post issue price should remain same. Any doubts till now? Issue price and post issue price should remain same. Now, the post issue value is going to be 50 into 21.2, existing 21.2, the original one, okay, 50 into 21.2. this will go up by 170, or you can call it as 150 plus 20, 150 plus 20. In short, whatever be the denominator, your numerator will be only 1230. You want to issue 1 crore share, 2 crore share, 10 crore share, 15 crore share, that's up to you. But this value will be 1230. This value is going to remain 1230. This is not going to be different whether you do a rights issue or whether you go for a public issue. What will undergo a change is numerator. Accordingly, this can undergo a change. Accordingly, this can undergo a change. Any doubts till now? So, sorry, denominator can undergo a change. Numerator will remain same at 1230. Any doubts on 1230? See, the point is, though I have called it as 50 into 21.6 plus 10 into 15, it hardly matters how many shares you are issuing. If you had issued more share here, somewhere the impact would have been at this place. Because positive NPV, negative NPV, somewhere, some place the impact will be there. In case, if you issue 15 crore shares at the rate of 10, the total will be 1230, your denominator will undergo a change. I'm not bothered about the denominator change. The overall worth of the company is only 1230 crores. Now, my requirement is that pre-issue and post-issue should be same. Pre-issue and post-issue should be same. So, post-issue price is 1230 divided by 50 plus x. X is the number of shares to be issued. 50 plus x. X refers to the number of shares to be issued. You can call this as y. Your post issue price is y. After the issue is closed, the price will be 1230 divided by 50 plus x. X refers to number of shares. Y refer to issue price. Issue price or post issue price, because both is going to remain same. Next, number of shares is equal to 150 crore divided by issue price. Number of shares is equal to 150 crore divided by issue price. Number of shares is x is equal to 150 crore by y. This and this you will get some two equations. Somehow you do the balancing, you will get the answer to x as well as y. That is what should be the number of shares to be issued and what is the issue price. The logic is that if I am subscribing to this public issue, before the public issue, at what price the public issue is made and post the public issue is closed, the price should remain same. That's one important thing. The second important thing is be clear on this understanding. Whether you make a rights issue, whether you make a public issue, whether you take a bank loan, whether you do XYZ, anything you do, the value of the firm has to be 1230. That 1230 comes not from the number of shares, it comes from the earnings ability of the company. That 1230 is the value for the earnings ability of the company. It's not because suddenly this company will say we are going to do a split. In a split, the 60 crore will become 600 crore. I can do 10:1 split. So my instead of 1230 by 60, you will call it as 1230 by 600. Instead of 1230 by 60, it will become 1230 by 600 or 1230 by 300. I'm least bothered about all of this. The important thing is the value of the company is reflective of the earnings ability of the company. It's not a reflective of your smart work saying that I will do a rights issue, I'll do a public issue, I'll do a buyback. All of that is not going to matter. Clear? Any doubts till now? So our assumption is we will assume the number of shares issued as X and the issue price is Y, then the next point which we are going to write is the investor will not be making a loss if the pre-issue price or if the issue price and the post-issue price is same. Clear? Now write next working note.
That 1230 previously you've given a working, right, saying it's the earnings ability. That is 50 into 21.6.
15. So okay, let's take it this way. It's 50 into 21.2. This is today's value of the company, which is 1060 cr. 50 into 21.2. You are doing a new project. What is the present value of inflow of that project? Only the that's the worth of that project. Okay, 170 crore is the worth of the project. So this is what the value of the company is going to be. Y minus 150 we are doing to understand whether it's a positive NPV or negative. See, if today TCS is going to do one more project, be positive NPV or negative NPV, if you are going to raise money from people and going to do it, the value of the firm will increase because more money is coming in. But money may come in to the extent of 400 crores, but value will go up only to the extent of 200 crores because you have done a negative NPV project. So here I am bringing in 150 crores, but my numerator gets added by 170 crores. That's because of the positive NPV. Clear? Any doubts? Now, analysis of the public issue option. Analysis of the public issue option. Analysis of the public issue option. The investor do not want to suffer. The investor do not want to suffer. Do not want to suffer any loss. Do not want to suffer any loss post subscribing the public issue. Post subscribing the public issue. Full stop. Consequently, the issue price and post issue price should be same. Consequently, the issue price and post issue price should be same. I would want both to remain same, then only the investor is not suffering any loss. Next point, let us assume the issue price, to be Y, and number of shares allotted to be X. Number of shares allotted to be X. Next point, the value of the firm does not change. The value of the firm does not change even if does not change with rights issue or public issue. Does not change with rights issue or public issue. Rights issue or public issue. Full stop. Hence the value of the firm for public issue option, will continue to be 60 crores into 20.5, whatever we have calculated earlier. 60 crores. Basically I am saying this 1230 will remain same. 60 crores into 20.5. 1230 crores. Any doubts on this? Any doubts till now? Now you end up doing this. Listen for a minute. Post issue price is equal to 1230. Okay, right. Post issue price equal to value of firm. Post issue price equal to value of firm divided by existing shares plus new shares. Post issue price equal to value of firm divided by existing shares plus new shares equal to 1230 divided by 50 plus x. X is the new shares to be issued. So you can write y equal to 1230 divided by 50 plus x. This is first equation, equation 1. Y equal to 1230 divided by 50 plus x. You have the second equation here. Analyze it and let me know x and y. The second equation is on the number of shares. The number of shares which I am going to issue is 150 crore divided by the issue price. Your xy will be equal to 150 crore. So you can substitute there in this equation. X into y is 150 crores. This y goes this side, xy becomes 150 crores. 50y plus xy is equal to 1230. In place of xy you can write 150. 50x plus xy is equal to 1230. Xy is nothing but 150. You have to make an issue at 21.6 CR. Sorry, 21.6 price. Number of shares you can calculate. Six crore 94 lakh 44,000 goes on like that. That many shares have to be issued. 6 crore 94 lakh some number. Any doubts on this? Clear? So technically your pre-issue price, issue price, post-issue price, everything is going to remain same. Because when we did rights issue analysis, I said existing price is 21.2, revised existing price was 21.6 the moment the project was announced. So pre-public issue price will be 21.6, public issue will be made at 21.6, post public issue also the price will remain 21.6. In all the three scenarios the price is going to remain 21.6. That is when the new set of people will not have any loss. Clear? Can we proceed? Now the last part says calculate the total benefit from expansion to existing shareholders under each of the two financing options. Listen for something. They've asked, see, the requirement is benefit from expansion. It's not benefit from the financing. A rights issue or a public issue cannot lead to any wealth increase. What can lead to a wealth increase is only a project. And the benefit to the existing shareholders will be 20 crores for both. We'll do the calculation, but it has to be 20 crores for both the scenario because that's the NPV of the project. It has to be 20 crores for both the scenarios. Now listen for some time. So I do a rights issue, I do a public issue, two options. Existing, revised. Number of shares, current market price. Now when I say existing, it's before the project is announced, okay? So before the project was announced, we had 50 crore shares and the current market price of those shares was 21.2. Current market price was 21.2 before the project got announced. So their value was this is the value they were enjoying before the project was announced. After the project is announced, the only thing which I know is the value has to become 1080, 20 crores NPV. That is what is going to happen in both the scenario. Now after the project is announced, if I do a rights issue, my shares will go up to 60. My shares will go up to 60. Price will become 20.5. Price will become 20.5. And these set of people would have taken a borrowing. Of 10 into 15. Would have taken a borrowing of 10 crore shares into 15. I'm doing the analysis at an overall level. So their value now is the net worth of these people is increasing from 1060 crores to 1080 crores. The net worth increases from 1060 to 1000. Now the question's requirement is very clear. It's for existing set of people, not for both set of people. When you do a public issue, existing shareholders will continue to hold 50 crore shares. They'll continue to hold 50 crore and their price is 21.6. No borrowing. Their net worth is 1080. Their benefit is 20 crores. Net worth is 1080. Their benefit is 20 crore. So if Whether you do a rights issue or you do a public issue, it doesn't matter. Before the project got announced, it was 50 into 21.2 CR. The moment the project is announced, if I do a public issue, it remains 50 into 21.6, a benefit of 20 crores. If we do a rights issue, it becomes 60 into 20.5. But to get to this value, the shareholders have taken a borrowing of 150 crores. They have taken a borrowing of 150 crores. Whether it's a borrowing or taking it from some other land and putting it, whatever be the way, their net worth will come down by 150 crores and will increase by 150 crores here. It will increase by 150 crores in the share side. Clear? Any doubts? So overall it will be 1080 and 1080 and the benefit is 20 CR. Please do this. Can you proceed? Any doubts on this? Okay, then I'll move to the next concept. We are done with rights issue analysis. I'll move to buyback of shares then. Okay, now as a concept, buyback means the company itself buys back the shares from its shareholders and then cancels those shares. So your existing equity capital is expected to come down post a buyback is done. There are certain conditions associated with buyback which is given in your Companies Act. So those have to be complied with by the company. There are restrictions on some debt equity ratio, number of shares to be bought back. So all of those restrictions have to be complied with, and post that a buyback is done. Now, why do companies do buyback of shares? Let's take an example of Tata Consultancy Services. TCS, if you look at their balance sheet, they'll have a huge amount of cash which is available. The reason for cash being available is it's a cash rich company. Every year they're making profits. You can declare some part as dividends, but balance part continue to be there in the company. If I get some new projects, new acquisitions to be done, I can deploy that cash. If there is no way in which I can deploy the cash, there are two things I can do. Either I declare it in the form of dividend, or I do a buyback of shares, or I keep it as money in a fixed deposit. No shareholder would agree to keeping the money in a fixed deposit because one, investment in equity markets is risky. So when I've invested in TCS and TCS is going to put that money in fixed deposit, I myself directly will put that money in fixed deposit. Why would I want TCS to put that money in fixed deposit? So in that case, TCS need not retain the money. TCS gives the money to me. I'll put the money in fixed deposit. If at all I want to put in FD, or I want to put it at some other place. So wherever you have huge surplus cash available, the companies will have to resort to buyback. A lot of companies have resorted to buyback in the past. So buyback is resorted whenever you have surplus cash. Now this surplus cash will be given to the shareholders. Now whenever a buyback is announced, most of the times the share price will move up. The reason for share price moving up is your buyback price will be more or less little higher than the current market price. They'll give the buyback price to be higher than the, so if the current market price is 1000 rupees, the buyback would be announced at 1100. So people feel that the company itself is valuing the share at 1100. So in case I am holding the share at 1000, this share the company will buy back at 1100. So the real worth of the share is 1100. That's people's perception, and because of that, a lot of people start buying in. When buying is more than selling, your share price keeps moving up and it moves a little closer to 1100. So whenever a buyback is announced, this could be a short-term phenomenon. It's not a real increase in price. The another thing which happens with the buyback is I correct my capital structure, I correct my assets and liabilities, I remove certain items which are not needed. See, any asset which is there in the balance sheet, against that asset there has to be a corresponding liability. There will be a corresponding liability. The corresponding liability can be an equity capital also. So when I have some unnecessary assets in my balance sheet, my objective is to eliminate them. That unnecessary asset is fixed deposit, which I'm talking about, or the cash which is there. So if that unnecessary asset is there in the balance sheet, let me remove that unnecessary asset. When I remove the unnecessary asset, the equity capital also comes down. Because of this, what happens is earnings per share moves up. Earnings per share moves up. Why earnings per share moves up is last year the earnings was 300 crore divided by 100 crore. Now this 300 crore will also include some interest income. That interest income is not the main income of the company, it's an insignificant income. So next what will happen is 300 crore, interest income of 6 crore is lost. But the number of shares from 100 crore may come down by 10 crore, 5 crore, it can come down by any number. So this can become 100 minus 5 crore, but the interest income is 300 crore minus 6 crore. So you will see the EPS moving up. When EPS moves up, P multiple is continuing to remain same and your market price of the share goes up. Your market price of the share goes up. That is a real increase because the company has corrected some unnecessary assets which are there. Buyback are done for a lot other reasons also. It can be done to prevent a takeover from happening. That is, if promoters are holding 48% shares in a company, what they will do is they'll start a buyback because promoters don't have money in their own capacity. So they cannot increase the stake to 51. What they will do is they'll buy back the shares. When you buy back, earlier it was 48,000 shares on 1 lakh. Now it will become 48,000 shares on 95,000. Accordingly, my percentage stake goes up. Accordingly, the stake which I hold goes up because I am not going to tender my shares in a buyback. So buyback can be done for multiple reasons. The major reason why Indian corporates do a buyback is when you have surplus cash. When you have surplus cash and you don't see a growth opportunity being there. You don't see a growth opportunity. I think buyback is also considered as dividend from a taxation point of view. So there also dividend distribution tax should be applicable. I'm not sure on it. So it's not from a tax angle saying that I will do a buyback vis-a-vis a dividend payout. Why companies don't resort to a dividend payout is when I do a dividend payout, in 1 year I may end up paying 400-500 rupees, and then later on I'll come back to something like 50 rupees, 60 rupees. Most of the Indian corporates would like to show a graph like this in dividend. They wouldn't want the dividends to show a huge increase and then fall like this. That they don't want to show. Otherwise, be it a dividend or a buyback, technically it doesn't make any difference from a taxation point of view, because your section 22 I think considers, or whatever the section definition on your dividend, whatever section is there, the coverage is that your buyback is also forming part of dividend analysis and will be applicable for dividend distribution tax. So this is one reason why people may opt for buyback vis-a-vis a dividend payout is, one, I don't want that huge increase and decrease to be shown. Second thing is, promoter will feel I don't want any dividends. Why do I need dividends? So let them do a buyback, because promoters are the main people. See, though you need a resolution and all, if you are holding a majority stake, your voting power is significant, you end up announcing a buyback to happen. So buyback can be done when you have surplus cash, when you want to prevent a takeover from happening. Another reason why a buyback is done is to give confidence to my shareholders. Sometimes what will happen is people feel that this company is making so much profits but still not declaring dividends. It had not declared dividends for a long period. So now I get a doubt whether really it is making money, or is it a accounting profit which they are reporting? Are they doing some window dressing with their financial statements? So in a practical world, a lot of issues keeps coming in. If a company is not declaring dividend, I don't get any confidence in that company. You make huge profits but not declaring dividend, not making a buyback, but you are still making profits, but none of them are happening, then I get a doubt whether really this company is making money or not. So these are the reasons why you do a buyback. Buyback reasons are, one, to prevent a hostile takeover if at all it is there. The predominant primary reason for a buyback is cash. You have cash available with you, you don't know what to do with the cash, you think let's give it to the shareholders, so you give the cash to the shareholders. Clear? Any doubts in this? Any doubts in this part? Now from a problem solving point of view, the problem will clearly define you what is going to happen in a buyback. They'll say how much surplus cash is there, how much surplus cash you want to give it to the shareholder, what should be the buyback price, what should be the post buyback price, every analysis. So I don't have any formula and all. The question will tell you what is to be done. They'll give you a buyback price, they'll give you a post buyback price, they'll give you shares which are to be taken. So accordingly your analysis will be like this. Okay, wherever we had done that X and Y calculation, we had calculated the number of shares, saying that X is equal to number of shares and Y is equal to the issue price. Similar relationship we are going to develop here. X will be the number of shares bought back, Y will be the buyback price, something will be the post buyback price. So somewhere that analysis will be done, and accordingly you calculate the shares to be bought back. Let's go through this question. Rahul Limited has surplus cash of 100 lakhs and wants to distribute 27% of it to the shareholders. The company decides to buy back shares. The finance manager of the company estimates that its share price after repurchase is likely to be 10% above the buyback price if the buyback route is taken. Number of shares outstanding and current EPS. You are required to price at which the shares can be repurchased if the market capitalization of the company should be 210 lakhs after buyback. Number of shares that can be repurchased, impact of share repurchase on the EPS, assuming that net income is the same. Go through the question. Okay, now I'll explain it similar to the earlier question. My post buyback market capitalization has to be 210 lakhs. Earlier problem, it has to be 1230 lakhs. Post the public issue is made, the issue price was to be, or post the public issue is made, the value was to be 1230 crores. Here the value has to be 210 lakhs. Now they are saying you have a surplus cash of 100 lakhs and wants to distribute 27% of it to the shareholders. So you are going to distribute 27 lakhs to the shareholder. This 27 lakhs is similar to 150 crores for the last problem. 27 lakhs is similar to the 150 crores. 150 crores was basically split into issue price, number of shares, X, Y. 27 lakhs will be split as buyback price, number of shares, X, Y. X is the buyback price and number of shares is Y. X is the buyback price and number of shares is Y. Last problem, issue price was X and number of shares was Y. 150 crores was to be raised. Here 27 lakhs is to be distributed. Any doubts till now? The only change here is, here they are saying after the buyback is done, the price will be 10% above the buyback price. So if your buyback price is X, post buyback price is 1.1x. In the earlier scenario there, the issue price and post issue price was same. Here buyback price will be X and post buyback the price will be 1.1x. Clear? Any doubts in this? They are saying if share price after repurchase is likely to be 10% above the buyback price if the buyback route is taken. So we will assume the buyback price to be X, post buyback price will be 1.1x, establish to equation and get the buyback price and number of shares to be bought back. That will answer your part 1 and part 2 of the question. Clear? Now working note 1, analysis of the buyback option. Analysis of the buyback option. Of the buyback option. Point number 1, the company has surplus cash of 100 lakhs, and wants to distribute 27%, of the same. Full stop. Hence the buyback quantum, would be 100 lakhs into 27%. Buyback quantum would be 100 lakhs into 27%, 27 lakhs. Like you have a new issue size, your buyback size is 27 lakhs. Next point, let us assume the buyback price to be X. Buyback price to be X and number of shares to be Y. Let us assume the buyback price to be X. So your buyback price is X, number of shares is Y. Now number of shares is equal to buyback quantum divided by buyback price. This is the first equation we are going to develop. Number of shares is equal to buyback quantum by buyback price. Any doubts on this? So x into y is basically 27 lakhs. Xy is 27 lakhs. Any doubts on this? Okay, listen for something. Now, post buyback price. Listen for something. Post buyback price is expected market cap, which is given in the question. Expected market cap divided by existing shares minus, not plus, minus shares bought back, minus shares bought back. My post buyback price according to the question is 1.1x. According to the question it is 1.1x, 10% higher than the buyback price. It's going to be 10% higher than the buyback price. Market cap expected is 210 lakhs. Market cap expected is 210 lakhs. And existing shares is 3 lakhs. 3 lakh shares are there, no? Sorry, 10 lakhs, 10 lakhs. Existing is 10 lakh. And shares bought back, the assumption was Y. The shares bought back assumption was Y. So you can, when you do the cross multiplication, it will become 11 lakhs minus 1.1 XY. You know the value for XY is 27 lakhs. Solve it, you will get the answer to X as well as Y. Clear? So the analysis is your post buyback price has to be 210 lakhs divided by number of shares currently existing minus the buyback price. So minus the shares bought back. Any doubts on this? Similar to the earlier analysis, the only difference is there we equated to x, here I am equating to 1.1x. Your X is coming out to be 21.79. That will be the buyback price. The buyback price to be taken is 21.79. Anyone getting 21.79? You have done minus Y or what? So it will be 21.79 only, no? It is like this. So ignoring this lakhs as of now, I ignore the lakhs. 1.1x is equal to 210 divided by 10 minus y. 210 divided by 10 minus y. 10 goes this side, it will become 11x minus 1.1xy. xy is 27. xy is 27 lakhs. X into y. So 1.1 into 27. This, when it goes to the other side, it has to be added. Just check whether you have added this when you go to the other side. So after that you will get 21.79 only, no? It is 21.79 only. Then only the post market cap will work, 210 lakhs. Just check the calculation. This goes this side, it becomes 11 lakhs x minus 1.1 xy equal to 210 lakhs. 1.1 xy is 1.1 into 27 lakhs. So when this goes the other side, it becomes 11 lakhs is equal to 239.7. X is equal to 21.79. Buyback price 21.79. Then number of shares. Any doubts on buyback price? Number of shares to be bought back equal to Are you getting 21.79 or no? Okay. Number of shares to be bought back equal to 27 lakhs divided by 21.79. Number of shares (27 lakhs) divided by 21.79. 123,910. This many shares will be bought back by the company. So the company is going to do a buyback of 1,23,910. See, wherever possible, whenever you do this XY analysis and all, possible check your answer after the calculation is done. That is, I have currently 10 lakh shares. So 10 lakhs minus 123,910. This many shares will be there with the company post the buyback. And post buyback, the price is going to be 21.79 into 1.1. 10% higher than 21.79. So this is what the value of the firm will be if the buyback is done, which is closer to your 210 lakhs. Otherwise, it's a rounding off issue. Broadly, it is 210 lakhs. If you do 16, you will not get that 210 lakhs ka information. So wherever possible, try to do this. This has to be done in calculator. You will not have time to do it in the notebook. If at all you have to do, you'll have to do it in the calculator. 10 lakhs minus 123,910. That is the number of shares into 21.79 into 1.1. Clear? Any doubts on this? Let's go to the last part of the question. Impact of the share repurchase on the EPS, assuming that net income is the same. Now please listen. EPS is equal to total earnings divided by number of shares. What are the current EPS the company is making? 3. So total earnings by number of shares. 3 is equal to total earnings by 10 lakhs. Total earnings will become 30 lakhs. Now what is going to happen to EPS is, today it is 30 by 10. Tomorrow it's going to become 30 divided by 10 minus 1,23,910. 10 lakhs minus 1,23,910 and EPS will go up. Normally, whenever a buyback is taken, your earnings will not remain same. It will come down marginally. It may not come down significantly, but it has to come down because you don't have the dividend income or the interest income anymore. So they have said it remains the same. So earlier it is 30 lakhs by 10 lakhs. Now it is 30 lakhs divided by 10 lakhs minus 123,910. Obviously the EPS will move up. Next, calculation of revised EPS. Calculation of revised EPS. Point number one, the company is currently having an EPS of rupees 3, full stop. Number of shares are 10 lakhs. Number of shares are 10 lakhs. Number of shares are 10 lakhs, and hence total earnings will be 30 lakhs. Total earnings will be 30 lakhs. Will be 30 lakhs. Next point. Revised EPS equal to 30 lakhs divided by 10 lakh minus whatever shares we bought back. 30 lakhs divided by 10 lakhs two decimal answer 3.42. So my EPS is going to increase because of buyback, and most probably it will increase, but your earnings should at least come down a little bit. So that is one reason why buyback leads to price increase. Any doubts on this? Clear? Let's move to the last question in this area, which is on dividend versus buyback. Y Limited has issued share capital of 1 lakh shares of 10 each, currently selling at 25. Their EPS is 3, surplus cash is 50,000. They are considering the following alternatives: pay dividend of 0.5 per share, use the amount to buy back shares, find P multiple, MPS and EPS under the two alternative. Now, as far as this question is concerned, they have not said the buyback is going to be value accretive or any benefits associated with the buyback. So if there are no benefits associated with the buyback given in the question, we will go as per the normal rules. When it comes to the normal rule, when I pay dividend, what will happen if I pay dividend? What is the impact of dividend payout? Share price will fall. So 25 will become 24.5. 25 will become 24.5. If you do buyback, share price will remain same, but number of shares will come down. Share price will remain same, but number of shares will come down. So whether you pay dividend or you do buyback, both are going to give you the same answer. Whether you do buyback or dividend payout. When I do dividend payout, it will become from 25, it will become 24.5 into 1 lakh shares. 24.5 into 1 lakh shares. If you, instead of doing a dividend payout, if you do a buyback, I have surplus cash of 50,000. Current market price is 25. 50,000 divided by 25, 2,000 shares. You will buy back 2,000 shares. The shares will become 98,000. The shares will become 98,000. Earlier it was 1 lakh shares into something. Now it is going to be 98,000 into something. Both are going to give you the same value. Either the share price comes down or the number of shares come down. So in a dividend payout, the share price will come down. Everybody gets the benefit of dividend. Promoter also gets some money and his value also come down. But promoter may not want the dividend. He will not be interested in it because he will feel that why do I reduce the value of my holding and take a dividend payout and I don't know what to do with this money. So instead of doing this, they may go for something called as buyback of shares. When you do buyback of share, it's up to person who wants to tender it for buyback. So there will be a opening period, closing period. Whoever wants to opt for buyback, they'll give the shares to the company and the company will buy it back. Clear? So let's start. Working note 1, analysis of dividend versus buyback. Analysis of dividend versus buyback. Analysis of dividend versus buyback. Okay, now please listen. They want these three information: P multiple, MPS and EPS. In order to do this, my starting point will be EPS, P multiple, MPS. EPS into P multiple is MPS. So these are the three things which we will try to capture. Before starting that, current EPS is how much? 3 per share. Currently the shares are 1 lakh. Now write point number 1. The company's current EPS is 3 per share. Company's current EPS is rupees 3 and the number of shares are 1 lakh. Number of shares are 1 lakh. Full stop. Hence the current earnings are how much? Rupees 3 lakhs. Current earnings are rupees 3 lakhs. Next point. The company that IPCC class in the other room. The company can use the surplus cash. The company can use the surplus cash. Either for dividend payment. Can use the surplus cash either for dividend payment or for buyback. Either for dividend payment or for buyback. Next point. In case of dividend payment, share price will fall by 50 paise. And the revised will fall by 50 paise and the revised price will be 24.5. Revised price will be 24.5. Next point. In case of buyback option, shares bought back will be equal to 50,000 by 25. Assuming everything is at current market price. I don't have any information in this question. 50,000 by 25. How much shares bought back? 2,000. Now listen for some time. Just to prove the fact whether you pay dividend or you do buyback, both are same if they don't give me additional information. Now please listen. Particulars, listen for some time. Dividend, buyback. My total earnings is going to remain 3 lakhs. If I go for dividend, my number of shares will be 1 lakh. If I go for buyback, it will become 98,000. EPS is 3 and 3.06. P multiple and MPS. MPS in case of dividend is 24.5. In case of buyback, it will continue to be 25. And your P multiple, whether you are doing this or doing the other one, remains same. Whether you are doing dividend payout or you are doing buyback, or your value of the firm, 1 lakh shares, both are going to remain same, whether you go for buyback or whether you go for dividend payout. In short, the value of the firm is not 1 lakh into 24.5. The value of the firm is 3 lakh into 8.17, 3 lakh into 8.17. The value of the firm is 3 lakh into 8.17, 3 lakh into 8. When your earnings remain the same, your total value is going to remain same for both the option. Unless the question would have said that the buyback can lead to some value accretion or something, then we would have factored in. So my earnings were 3 lakh and 3 lakh. Number of shares remained same, but it fell here. When it fell, EPS went up, market price is up. When number of shares did not fall, market price fell because you paid out money. When you paid out money, your market price fell, your P multiple has remained same, EPS has remained same. So kind of the adjustment is automatically done here. The P multiple will remain same whether you go for dividend option or you go for buyback option. Clear? Any doubts on this? Present this now. Whether you go for dividend payout or buyback, both are going to make no difference according to this question, unless the question gives us additional information, and practically also both shouldn't make any difference. The only thing is promoters may not want a dividend income, so they want to increase their stake, they may go for a buyback option. Done? Can we proceed? Okay, now we'll just write the summary of this and end. So go to the last reverse order, go to the last pages. Topic 24, rights issue and buyback. In the reverse order, last pages of your notebook. Topic 24, rights issue and buyback. Topic 24, rights issue and buyback. We'll write the summary for whatever we have done today. Either I give it at the end of the class or at the beginning of the next class. Topic 24, rights issue and buyback. Question number 1. Question number 1. X rights price equal to X rights price equal to X rights price equal to existing shares into existing price, existing shares into existing price, plus new shares into issue price, existing shares into existing price plus new shares into issue price, whole divided by existing shares plus new shares. whole divided by existing shares plus new shares. Next point, theoretical value of right equal to theoretical value of right equal to theoretical value of right equal to x rights price x rights price x rights price minus rights issue price x rights price minus rights issue price x rights price minus rights issue price. Next point, a shareholder should either subscribe or sell the rights in case he ignores the rights issue then wealth will reduce Question number 2. Point number A, current market price equal to EPS into P multiple. Current market price equal to EPS into P multiple. Next point, the market price will increase by the amount of positive NPV by the amount of positive NPV with the announcement of project Next point, NPV equal to present value of inflow minus present value of outflow. NPV equal to present value of inflow minus present value of outflow. Next, present value of inflow equal to cost of the project into rate of return into P multiple. Cost of the project into rate of return into P multiple. Question number 3. The company plans to do a new project. And the acceptance slash rejection of the same will depend on the amount of NPV. Next point, present value of inflow equal to cash flow of year 1 divided by cost of equity minus growth rate, KE minus G, divided by KE minus G. Cash flow of year 1 divided by KE minus G. Next point, KE will be calculated as per Gordon's model. Full stop. P naught will be taken as in a different color pen X dividend price. P naught will be taken as X dividend price. P naught will be taken as X dividend price. P naught will be taken as X dividend price. Next, I don't have any other major adjustment there. Question number 4 then. Question number 4. Buyback price will be assumed as X. Buyback price will be assumed as X. Buyback price will be assumed as X. And post buyback price will be assumed as X, and post buyback price will be 1.1x. Post buyback price will be 1.1x. Will be 1.1x. Full stop. Next point. We need to establish. The buyback quantum. The buyback quantum is rupees 27 lakhs. The buyback quantum is rupees 27 lakhs. Buyback quantum is rupees 27 lakhs. Full stop. Or hyphen issue prices. Sorry. Buyback quantum is 27 lakhs. Hyphen. Buyback price is X. Buyback price is X. And number of shares bought back is 27 lakhs divided by X. Number of shares bought back is 27 lakhs divided by X. 27 lakhs divided by X. Next point. Post buyback market cap is available. Post buyback market cap is available. Post buyback market cap is available. And with the help of this, post buyback market cap is available, and with the help of this, we can calculate buyback price and shares to be bought back. We can calculate buyback price and shares to be bought back. Question number 5, no special adjustment. Question number 5, no special adjustment. Question number 5, no special adjustment. With this, I'll end today's session. I'll be giving you homework sums in the WhatsApp group. I've already given you sums for your earlier area dividends. So if you are not there in the group, just send me a message so that I add you to the group.